All right. Hello, everybody. Today is Wednesday, August 16th. Year flying by. It is 1 p.m. This is our Opex Live. I believe we are connected on the various interwebs. Let's make sure here. Looks good. All right. Here we go. Today is a new Opex Live format. It is just Brent. So I will be doing my best to talk to myself and work through all of these Opex dynamics. So thank you for joining me today. A lot of interesting things happening. We want to touch on the volatility complex right now, which is pretty interesting. For those of you who really want to dive into that topic, we have a nice formal presentation that we did with my friend Jack from Excess Returns. He is a wonderful YouTube/podcast. Go check that out. We just dropped our Opex Live where we talk about the volatility complex, Nvidia, and some different things like that. I also want to touch on Nvidia itself. Obviously, the stock is moving up. That's a stock we've been kind of, we've been hitting on that recently, I would say. And the thing about Nvidia is we just see it as the call implied vol is pretty cheap. And that seems to be a theme really for January in general. So we'll be touching on that. I want to touch on Captain Condor, as we've called him. This is a fund that is trading big 0DT Condor positions. Yes, lots of interesting and fun things to talk about there. All right, let me bring up my old screen share here. And we will get started. Let's just start with what's happening today. And this gentleman, I don't even know if it's a guy. It could be a girl. It's likely a fund. What you see on your screen here is Trace. Trace shows you our proprietary dealer positioning, and we show you where we think dealers and market makers would have to hedge. So what is their hedging position in real time? And so what you can see through our map here is the dealer's point of view. And what you most notice here is this, right? This is a big call spread and a big put spread. And this is in the 0DT, this is a 0DT position. If I turn on 0DT, you can see it is only a 0DT position. There we go. So these are big strikes, about 20,000 contracts. So if I just hover over that, you can see it. 27,000 contracts is the total size there. What's interesting is this is about double of what the position was yesterday. This Condor sellers been coming in a lot over the recent months, really. And the deal seems to be that if they lose like they did yesterday, they double down in size. And so today we had VIX expiration this morning. We had what looked like it was going to be a little bit of instability. The market overall has trended, I guess, starting up. And when you look at gamma for today, what you can't help but notice are these two big nodes here, right? Which seem to be the path that the market wants to take at the moment. So the deal is that the dealer is long this call and they're short that call. And what gets interesting about this is that it's not necessarily, the audio keeps cutting out, people are saying. All right, everyone's saying audio is good. All right, thanks, Michael D'Souza, for confirming I'm doing all right on audio here. So anyways, back to the trade. This is supplying some positive dealer gamma to the market. There's no doubt about that. We're overall in a very stable environment. 90% stability tells you from a gamma perspective that there's a pretty big dealer complex buying dips and selling rips. What's interesting about the Condor trade is that, particularly as we get into the close and we start to look at the charm aspect of things, this likely becomes a significant P&L, pure P&L trade, not so much how I'm going to hedge this thing. But what I mean by that is this is 20,000 contracts. And let's say that, as I wrote in our founder's note, they sold that for a max of, $2. So, you're talking about a $4 million P&L, and every point we go through that strike, that $5 wide strike, is another $2 million of P&L, right? So if the fund could lose up to $6 million on that trade, which would mean that the dealer or the market maker on the other side would make that money, right? So if you're going to get into this zone with 10, 15, 20 minutes left and we're near this area, it seems to me that somebody's incentivized to push the market maybe through this call spread to make sure that this spread expires in the money, right? And not only that, as I alluded to in the founders note this morning, the fact that that this fund seems to double down on size or increase their size almost skews the trade to be more guaranteed against them, right? If they start getting to like 50,000 contracts, you're talking about a lot of money. And that's an even stronger incentive for somebody to push this market through that spread, right? So I think that's really a pretty fascinating. It's a pretty fascinating thing to watch. The other thing is, if you look at yesterday, so if we bring up yesterday's map here, the market, we had been positioned for a pretty quiet market overall. I would note that the 0DT straddle today was priced at $25, really pretty cheap. Yesterday was a similar price. And what I highlighted to users this morning was look at what happens at around 2 o'clock. So here's 2 o'clock, and we can replay this. And here are the condor trades. You could see several spreads in here, and you could see these spreads will change and adjust as the market starts to fall apart. And so, particularly at 3 o'clock is when we get this big drop in the market. You can see HIRO moving down, and then you'll see the spreads change, right? And so, what that is telling you, as you can see here and here, right, is that these 0DT positions are giving way, right, or causing market movement. And I think a lot of times as traders, well, we're looking around and saying, "Oh my gosh, like people are getting really bearish right now. What's going on? Let me look for a macro reason for this or something else." And it turns out that there's just these pretty sizable 0DTE positions flailing around that can change your maybe your view looking forward, right? So the bigger that these positions get, I think the more impact they obviously have. That's not I don't think a shocking thing to say. And at the moment, Captain Condor's got a big trade sitting here. And you got to believe if they take an L on this one, I don't know how big this fund is. I don't know how much assets they have. I don't really know anything about them. But you keep taking $2, $3, $4 million losses. I don't know how much longer you want to do this. The other thing is, the more people start to get aware of these trades, right, the more this whole thing can kind of get gamed, and then they can be adversely impacted by the weight of their own trades. And I think that's the big thing to note here. Is like, kind of like the JP Morgan collar trade, right? If you look at the history of that trade, there's been 2 times over the last 5 years where that put strike, their long put strike has been tested, and the market closed, funny enough, 5 handles or 10 handles above their long put strike twice. So what does that tell you? Well, they own this put to hedge their huge portfolio, but the position's so big that the market makers keep it out of the money, or the dealers keep it out of the money. So what good does it do? I don't know. And then the last thing I'll say on this, and what's funny is, you post things on X, and if you make like a inappropriate joke, it'll get a lot of likes. But if you post something that's really interesting, it tends to get kind of ignored a little bit, I guess I would say. If you look at this is our fixed strike vol matrix, and one of the cool things you can do here is you can look at vol skew premium. So that's what this is. Skew premium. So what this is showing you is, as it says, it's the options contracts premium delivered by the skew in the market, and you can see the distortion of prices around where these condor trades are positioned. It's something that I think is really interesting, and so what you can look here is you can see the skew is different in here, right here, where this condor is positioned. And that skew premium will change throughout the day, but basically what it's saying is I think the options prices for 0DT are being adjusted around where this position sits, and that would incentivize possibly offsetting exposure. So let's be very specific about this. You see 58.45, 58.50 is where that strike is. And so I hadn't looked at the vol skew premium today. I posted something about this on Twitter/X yesterday. So let's just take a quick look at that. And so 58.45, so right in here is that skew premium, right? So you could see that the skew seems to change right in and around the strike, right? There's a lower premium here and a higher premium out here. So what does that do? Well, I mean, these options aren't worth that much now because it's 1 o'clock, but you can see the same thing in the morning. Is the dealer incentivizing call sellers above? Possibly, right? So pretty interesting to watch the fingerprints of this trade as it gets bigger, make its way into the market. All right, Luna says that we're good with audio too. All right. I actually upgraded my microphone. Not that all of you care about this, but I had a lot of audio issues before, so I've been working on that. So does that mean that we pin today this area? I think if I was going to bet on a pin, I would look for us actually to attack this top strike. Move through that strike. So an interesting way to look at this would be, look, if we get to, let's say 3 o'clock, kind of the witching hour for these 0 DTEs. If we go to Charm, you'll see what I mean. So the model here says that essentially it's like a candle, right? We're hottest by the base of that flame. So as we get into 3 o'clock, you can see that red color, the charm effect picks up a little bit. Well, we know that the dealer will make max P&L, if we move to 58.50. So if we get to like 3 o'clock or 3:30 and we're maybe in this neighborhood, can you put on a cheap 0 DT structure that puts yourself on the same side as that dealer? I've not back tested that idea, but I think these 0 DT options are obviously cheapest or lowest premium price as we get into the end of the session, and so it starts to get interesting to me if you can lean on this yourself and structure some call flies or call spreads, or maybe just an outright cheap call, something like that, to bet on basically this bell getting rung. It's an idea I've had that been sort of working up and thinking about in the background, but maybe you all can take that baton and run with it a little bit here. Lauren asks, doesn't the dealer delta hedge their exposure so they don't care? It's an interesting idea in this situation because there's the overall book, right, which is there's likely 0 DTE desks at these market makers, and then there's the all other expiration market makers. And so there's the idea that to the point of distorting the vol surface a little bit, can you put on enough other offsetting positions on the day that you don't care that much about this P&L? And I think that's very easy to do when it's a 5, 6, 7,000 contract condor maybe. But if you start talking a 20,000 lot condor, okay, that's a little bit more difficult, I think, to just hedge out, right? Using other options positions. The other thing that's tricky about this is it's just a spread, right? It's a 5-point wide spread, so the notional exposure of it shouldn't be all that big. So do you buy and sell futures around it? I mean, possibly. But I also think that the bigger, again, the position gets, the more you're incentivized to try to move the market through that strike. You want to classify that as hedging it or whatever, that's fine. But in theory, if you're long this call spread, are you going to be selling futures against this? Maybe you wouldn't if you jam that call spread through, you make $2 million a point, right? A hand per handle. So I think this is what I was trying to get to at the beginning, Lauren, where there's the hedging dynamics of we're in a stable market, we should be buying the dip, selling the rip, it's stable, and then we get into this area and the market's going to be dominated in here by this single trade, right? Because that's the biggest. Is there anybody else out there whose P&L could swing by 5, 6, 7, $8 million in the last 10 minutes of trading before this trade expires? Probably not, right? So this becomes the most dominant factor in the market for a brief period of time. So that's the idea. All right. I want to pivot now to talking about election implied volatility and some of the dynamics there, given that we had VIX expiration today. No secret here, the term structure is quite elevated for election. I wouldn't say quite. We're 16% implied vol is what these longer dated options are pricing in for movement. 16% IV is roughly 1% daily moves for the S&P index. That's not actually all that high, and this vol actually seems to be coming down a little bit. So that's kind of dynamic one. Dynamic two is this. Right now, as I mentioned earlier, we're pricing in, for a 0 DT perspective, we were priced in 40 bips of movement on the day. That's nothing, right? That's about as low as we get on that 0 DT pricing. As you can see here, the non or pre-election implied vol is at lows, right? This is the 90-day lows, this cone, or 90-day range, excuse me. That's what this cone is. So implied vol right now, pre-election, is pricing in no movement whatsoever. if we look at realized volatility, SpotGamma subscribers understand this kind of already. We've been through this a bunch of times. In green is 1 month realized vol, and red is 5-day realized vol. You can see both of those metrics are near lows, right? You can get a little bit lower, but we're essentially at lows. And realized vol is measuring how much the S&P has moved over the last 30 days or so, or 5 days, depending on what the metric is. And so the point here is that we've hit a floor on realized vol. We don't have to bounce off that floor, but we're about as low as we can go. And the options market right now for pre-election vol is pricing in essentially no more movement than what the market has already been doing, which is, let's just say it basically is zero. There's that famous saying that there's nothing to fear but fear itself. And it sort of relates to this idea, I think, in the volatility complex, because right now we have 0DT pricing in essentially no movement. We're priced for perfection. Realized vol is at a real low. And then the second dynamic is we have this options expiration coming up. We've shown a multitude of times the link between gamma and volatility, in that when we have larger positive gamma, there's less volatility in the market. We've proved that with our original models that started SpotGamma in January of 20. We've also shown that with our new trace data, where our proprietary modeling shows the similar effect. So this is call positions right now for this is for all major indices, and it's not a huge options expiration. It's bigger than August, but a little bit smaller than July. But what we have is about 4-to-1 call to put positions. So there's a ton of calls right now in the market, which have been built up as equities have rallied over the last really 2 weeks. And that is offering or providing a lot of positive gamma, I think, especially in the index complex. And so we have realized vol at lows, right? 10%. We got 40 bips on the straddle. And then we're going to lose a bunch of this positive gamma that has been, in my view, suppressing market volatility. It's been keeping things very calm. So this all lines up for, I think, a pretty good turning point in the market. And, I wrote that I thought VIX expiration is when, some people call it the window of weakness will open. You want to call it that, that's fine. I think today is when that starts to loosen up positions. And so the risk off flag for us here is 5,800. If we break that, then I think we're going to move down pretty significantly with 5,700 kind of the level that we're watching. And if we look at just pure positions here, we can look at it in trace as well. So let's do that. So we go to trace and we just bring up OI. We see your pure open interest here, and we can zoom out a little bit and just take a look at what that looks like. Sorry, I got to zoom out the other way. I'm going to turn off 0DTE. So what you notice is here is there's a pretty big balanced put strike here at 5,700. There's a lot of short puts, a lot of long puts. And I think that in terms of a post Opex sell-off, I'd really be watching this level as major support. And so we're about 2.5, maybe at most kind of 3% from, I think, where a post Opex move down could start to hit. Positioning overall, if you look at this gamma map, what strikes me is that this whole map is pretty much blue, right? Which infers that there's not a big negative gamma complex looming just below where the market is trading, right? There's not this kind of reflexivity to the downside that is pending, which is why I don't think we could move down a whole lot more than maybe that 5,700 to 5,750 range, and that would just be a function of almost like hedge rebalancing, right? I just don't see a big red ugly negative gamma complex that's sitting there. If you look at the tail risk hedges that have been added over particularly in early October, most of those were added way down by the kind of below 5,500, 5,000 strike. I mean, they're pretty far out of the money. Same thing with VIX calls, or more out of the money VIX calls. And so it's pretty interesting to me that I think even if we have a little bit of a pullback here, I wouldn't expect much to be substantial. And then we turn to the election itself. The election itself, obviously, as we just showed, has a event vol premium to it. I want to turn to this slide deck because the slide deck had the slides that we showed in the excess returns episode. And what we see has been happening. Let me just share this the right way. So what we see that has been happening is I looked at, this is November skew for the S&P 500. And the gray line is from 10-1. And the teal line was from yesterday morning. And what you see is that the put wing has come down and the call wing has started to come up. And with that, we've had a pretty strong equity market move over the last 2 weeks. There seems to be a lot of consensus that the market is going to rally into the end of the year. And I say, unfortunately, I agree with that because I think that the consensus, is often wrong. But you see the demand coming, right? And I know a lot of people are screaming about Nvidia today, and we could take a look at that as it's moving up pretty well here. But clearly, this is the market for one reason or another starting to position for a market rally, and they're starting to discount election-related volatility. I don't know why they are doing that. Is it geopolitical? Is it just simply a geopolitical issue where the Middle East situation hasn't, picked up, knock on wood, and that's eased some pressure. Rates have stabilized. I made a joke on Twitter with my friend Jack about, this is poly market, and this is the odds of Trump in green, and then here's S&P going up. Correlation is not causation, and so I was laughing at, if you wanted to complain about this chart, email Jack, because you say Trump and that usually gets people upset. But, there's that factor, right? And then when you start to look at the positions above, this is 6K, which is only 2-3%. This is the 60-55 JP Morgan strike. So, this becomes a big beacon of upside. And I don't even think this would take to December, right? This could just happen into mid-November if the election is clean and goes off without a hitch. And the main fuel for that is that even though this vol has come down a fair amount, there's still plenty of room for that to come down, right? If we just look at this chart takes the VIX and it subtracts 1 month realized vol. So we talked about how 1 month realized vol for the S&P is 10%. Well, the VIX is at 20 right now, right? So that's a 10-point difference, which puts us right about here. So there's a big implied vol premium. We're not moving at all, but the market's pricing in a lot more relative movement. And if that VIX drops, if that implied volatility drops, that should result in bullish flows into the underlying markets, which is the main reason that we're looking for a rally here, regardless of who wins. That just seems to be kind of the setup. Now, the other thing is, and those of you who've been following me for some time know that I spent a lot of time talking about Nvidia. And in fact, if you go to SpotGamma's blog, you can look at the Nvidia industrial complex. We did a Tasty Trade segment with Victor Jones. I got a lot of attention around this. And it's just the idea that Nvidia can lift the entire market. And why do I believe that? If you look at, number one, this is what Nvidia has done over the last, call it 2 weeks. It's up 18% roughly, where the S&P is up 4%. And again, this is of yesterday. Obviously, those stocks have moved a little bit. But what does this serve to do? Well, I've asked this question before, so if you paid attention, how many ETFs are in how many ETFs hold Nvidia? Any guesses out there? Those of you who heard me probably already know. All right, I'll tell you, 523. So why does that matter? Let me find that exact chart that I'm looking for here. Sorry, I lied. 528. So we have 528. Luna, you said 4. It's 528. This is a chart from September 11th, where Jensen Huang made the comments about NVIDIA's chip demand being, insatiable, and the market ripped off of lows and never looked back. On that day, Nomura calculated $8 billion of levered ETF rebalancing having to go into the market. So you have 528 ETFs hold NVIDIA. That goes from triple long NVIDIA ETFs to Nvidia being 7% of the S&P, 25% of the SMH, right? And all of that ETF generates ownership, institutional ownership. And the rub here, or my point on this whole thing, the TLDR, is that I think that the underlying liquidity of Nvidia is actually a fraction of what people think it is, because there's all of this stock that is synthetically locked up with these ETFs, as well as people who just own the stock because they think it's going to never go down. And so what happens is when you start to get a big call options complex, people buying a lot of calls, that should, in theory, invoke dealer hedging flows that have to buy the underlying shares as well as sell if the stock goes down. They're chasing, right? And that levers Nvidia stock. It makes it move at a much faster pace. And so I think that's why you can have a $3-4 trillion market cap company move at a 5, 6, 7% daily. They have 4, 5, 6%, 7% daily moves. So what do I think is interesting about that right now? We talked about the Nvidia industrial complex both as a driver of market highs and lows over the last year. We tons of content about that. What is interesting about this current position is if you look at where Nvidia has moved, right? Here we pinned the JP Morgan strike 57.50 and sold off, and then you see the bid start to come into Nvidia, right? And then the S&P seems to have, for whatever reason, I think Nvidia is definitely part of that rally. The equity market has started to move up. Nvidia at all-time highs, SMH at all-time highs. You can really see that complex picking up. So many of you are probably saying, "Hey, Brent, get to the point." This is not a new phenomenon. We were talking about this one Nvidia, 2 weeks ago. And you think about how you want to position for the end of year, or just what are the interesting trades, or how do you express upside views now? And if you look at Nvidia options skew, it's pretty surprising to me, because this stock obviously was the primary driver of the major equity market rally over most of 2024, the AI complex, right? The chip complex. It is, I think if you listen to, a lot of macro people, you say, well, how can America save itself from all this debt? Well, we can have 5% GDP due to, explosive AI chip renaissance, right? I don't know if that's true or not, but that's just the kind of the line of thinking. So you can see that at the money implied vol is now lifting up a little bit. So this is a 90-day range, and this is November skew. And you go, okay, the call wing is lifting just a little bit, but this is not a call skew, right? This is a put skew, which for Nvidia is weird, because if you looked at this for basically any day before June this year, even before July this year, you would have seen the skew look something more like that, right? Where the calls have a significant implied vol to the puts. And so I wanted to show Jan options expiration here, because it kind of highlights, what I'm getting at. So there's your 90-day range for a option that has got about 90 days to expiration for January. And as you can see, the upside in particular has a lower implied vol now than it's had at any point in the last 90 days. You're talking about a pretty low implied vol for calls, even when the stock is at all-time highs. We just breached all-time highs again, right? And Jensen just came out recently on a podcast and made some incredible remarks about demand again. And what this tells me is that, and we have other data that supports this, what this tells me is that there's actually been a lot of call selling in Nvidia. I think it's overriding. And the fact is that we've hit all-time highs, but we've not yet had this negative gamma call buying complex come in Nvidia, in my view. And I think that if that is invoked, then you're going to see these implied vols lift. And then I think you start to look at these situations where, Nvidia has the kind of runs or moves that, we were used to in the first half of this year, right? Where it was just going up at a pace that was hard to understand. So if I, just zoom out a little bit on that, these types of moves, right? These are call driven, call mania type moves, and I think that if the market does rally out of the elections, which I have a lot of conviction around that, assuming we get a nice clean election, meaning within a few days we know who the presidential, who the next president will be, we can move on with our lives. Then vol starts to lift, and then we see this chip complex really start to outperform. So that's the kind of setup I'm seeing. And if you look at in Equity Hub here, we have skew rank and vol, implied vol rank. And so, that's pretty valuable for assessing just where these vols lie. And this is on a 1 month basis. But if I scroll over here, what you'll see is I'm in my dev system. Pardon me there. That's why I'm holding up on everybody. By the way, we're frantically working to update our models in Equity Hub, so you'll actually be able to see where the long puts and calls are for the dealer perspective. So here's the history. So if I just scroll over a little bit here, we want to look at skew rank is 11. That tells us that puts relative to calls are highest that they've been year to date. That's where that ranks. And then IV rank is a 31. So, this was lower, as you can see. And these are lifting a little bit, right? The market's starting to warm up to this idea of an Nvidia bull run, I think. But this IV rank is also obviously in the lower half. So I don't know if I'm right about an Nvidia year-end rally, but what I can tell you is the skew rank is very low, or put skewed. We're skewed to puts in a way that we haven't been recently. And then the second thing is that the I vol rank, implied vol rank, actually seems pretty low right now, right? We're in that 30% range. So that's what I think is most interesting as far as Nvidia goes. And then I would also say, the other one you want to start to maybe look at is Tesla in this situation. If they have earnings on the 23rd, obviously the skew rank a little bit higher as is vol rank, with the earnings coming up, but the January options have a kind of similar look to them. So a couple interesting things out there. Yeah, but B Money just asked, I think it's looking bearish. I don't think it's looking kind of bearish at all. Andy, I'm glad to hear you like the Equity Hub. Yeah, so essentially what we're doing is you're going to see where, in addition to this absolute view, which shows you the total gamma at various strikes, we're going to show you where we think market makers are positioned. So that's really neat, and that is in development now. So we're checking that out. A couple questions on a spreadsheet that we offer. So if you go to spotgamma.com/Opex, we have a Opex spreadsheet, and we detail the names that have the biggest options positions expiring on this upcoming Friday. I saw somebody ask there in that sheet is a column that compares stock volume relative to gamma. And the idea is that when you compare the gamma or delta relative to the stock volume, you get a sense of liquidity, right? How big is the gamma complex, right? How much could hedging possibly impact the stock? So to do that, if you look at the gamma or delta, depending on your analysis relative to the share volume, then you get a good approximation for impact. And incidentally, if you look at this composite view, the coloring of the composite view gives you an indication of that as well. So at any rate, just to make it clear, go to spotgamma.com/Opex and you can download that sheet. Trader Phil asks if I track the straddle price. I currently do not. It's something that I'd like to do. It's pretty interesting. We have the data. I just haven't been tracking that. Brent's astrology hour. Yeah, no problem. B Money there. We were going through that. All right. So those are, looks like I get up on all the questions. And those are essentially the keys to the Opex view here. That this removal of options expiration, positive gamma should allow the market to, I think, weaken into early next week, looking for the 5,700 area test. And then I think, is there a reason for the market to catch a big bid into the election? I don't know. But I think it's safe to, I think I would be looking to use any pullback to express probably those January options as a view, because that implied vol just seems relatively low. And at the end of the day, if you're buying what you believe to be is low implied vol and selling high implied vol, then that's part of what the name of the game is, and you have the data to back that. Then it makes some sense, right? It takes some of the guesswork out. And right now, as we approach the 2:00 hour here, we got a ways to go to attack that strike, right? Right. We got another 15 handles. I don't know if we can pull that off. It doesn't always have to happen, but if we start to get within 5 or 10 handles of that strike, then I think we can really mark that. Yeah, and what am I looking for? I mean, look, the biggest strike on the board right now, and it's a big strike, is 5,800. If you just look at this, right, it's huge. So that's $300 million of calls and $300 million of puts on an absolute basis. So this is a big level, and this level remains like this. This is again 5,800, likely until Opex, right? Opex days should start to move around. To the upside here too, you have 5850, another huge strike. So, we're really starting to get kind of locked down in this general area here. And then, this gamma should all reduce significantly. And then I think we start to, possibly pull back lower. That's the way that I'm looking at things. The issue here too is that, as we mentioned, is these 0DT options or the short dated options, they're trading at such a low implied vol right now. It's like, do you really want to sell those anymore? I mean, I think that, there's times where it seems juicy and we're selling. There's a lot of traders that will only sell those and have to do it every day, kind of like the condor guys. They seem to have to do it irrespective of price. Maybe they're very sophisticated in their logic. I can't say, but I think when implied vol is this low and you're going into this Opex, it just doesn't make sense to necessarily sell these options anymore, right? The short dated options. Maybe you don't want to go long them, but shorting something and deciding not to go long are two different things, right? Yeah, in the I see late people coming in about the Captain Condor position. Hopefully, I'm not upsetting somebody with the Captain Condor thing. Just struck me as funny. And here we go. But this is the position. You could see it. You could see it here. Like this call side is the side that may be under pressure. The put side is down here. So that is the current big 0DT position. And you can go back in time and look at these if you'd like as well to see how the market reacted to them. All right, any other questions? Fire away here. I quickly covered. I tend to go very, very fast through things, and without a counterparty to chat with, it slows me down a little here. So what about Nvidia for this expiration? Let's just take a look. There are a lot of positions at 140 right now, particularly on a new model. We see the dealers as long 140, which is right here. And right now we got about 35% of total gamma expiring. That's a pretty material amount of gamma, but there's not one specific standout strike into the current expiration, right? You could see there's 130, there's 135, there's 140. So there's a pretty big range of positions, and these should get wiped out and removed. And again, when I look at that low call implied vol, you look at these comments coming out from the CEO. I mean, he's invoking words like trillions, and you're like, all right, if he's off by an order of magnitude, it's still really big. So I don't necessarily know what to think about that, but overall, this is a market that is well hedged because of the election. A lot of tail hedges on. It's at all-time highs. It just doesn't seem to care generally, about risks. And I don't know that you necessarily want to fight that, particularly if we're going to get kind of this Vanna flow, right, when implied vol collapses and things really start to move. Another stock that caught my eye that was interesting, if you just want to compare and contrast things, is DJT's really that stock's just going kind of crazy. And so if you ever want to see what bananas looking implied vol looks like, go check out DJT. So I'm telling you, Nvidia vol seems cheap to me. Well, this is very high implied vol, right? This is absurdly high implied vol, as you can see here, right? 300% implied vol, and broken wing butterflies are possible ways to play this. I don't think you want to sell calls or Maybe you want to sell call spreads if you have a view, but you don't want to be short calls on this thing because, this day and age, who the heck knows what could happen in this kind of situation. But that name is particularly interesting. And also keeping an eye on these uranium stocks are starting to go a little bit crazy. So the implied vol and some of those names are really starting to lift. I know, this complex is starting to kind of heat up, and this is an environment where, you see these flows we saw all year. Just choose a vector of attack, right? And they charge in, and that can really cause some incredible market movements. And so uranium, CCJ, names like that, the implied vol is getting really rather rich. And when I see that, I think that, okay, like that is a sign that this is overbought, right, in the short term. Uranium is not wildly overbought to me. The DJT is so related to the Trump trade and the election trade, obviously. So there's that extra factor. But when you're talking about calls that have a 300% implied vol, if he wins the election, who knows what the heck kind of stock price move you see on that, but you assume eventually that call implied vol comes in on that. So you can really use these elevated implied vols to structure something. And the last thing I would say on the point of Tesla is that look, their robo-taxi day was not all that interesting, right? It left people unimpressed. We have been very clear that the support line for Tesla was 220. You can go back and read our notes on that. And what was interesting is we kind of just moved down and we pinned that level, right? We're just sitting on that level. If you look at how people are positioned down here, it's largely reads to us like traders have been selling puts. So dealers actually have a positive gamma positioning down here. That's what our new data is telling us. And to the upside, it's mostly traders that are long calls expressing upside. Now, that's come in a little bit after the robo-taxi event was kind of underwhelming. They got earnings next week. I don't know how, I don't know what that looks like. I'm not here to offer anything. But you got to believe, man, if Trump wins, and I don't know if he is, and this is not a pro-Trump statement, but what strikes me as interesting about this is that Nvidia should go up regardless. I don't know of who wins, right? As long as it's a quick and easy election. I think Nvidia could succeed. I don't know what Tesla does if Kamala wins. Again, I'm not trying to get stuck in the mud of a political conversation. But Tesla is the OG of gamma squeezes, right? And I think that you could really see, based on current positioning, if the earnings are all right and if Trump wins, is Tesla the stock that just starts to really become, does it start to move into the image of what it once was? And in a lot of ways, it's kind of a forgotten stock. It still is a top 10 options volume name. It's just that there's a whole HFT complex that I think trades Tesla that's not the kind of Wall Street bets gamma squeeze crowd, right? But look at the call implied vol there for Tesla. And, I think that this could really be probably the most interesting thing to own if Trump does win. Particularly if the earnings are okay. The dynamics there obviously would change for Elon and crew, and I think they could be a super interesting name to get long. And again, the implied vol seems pretty reasonable there for those Jan options. Sorry, scrolling through some of the questions here. What is the usual VIX range going to the election? Asked Ezra. That is a good question. I actually had gone through that before, and the exact level is escaping me. But the VIX is actually under 20 for the last election, I believe. So if we just kind of zoom out on this, I think I can zoom back without changing my time frame. I cannot. So let's just look at the weekly here. So right in here is where you see the previous election, right? So there we go, right there. So we were right around this 20, kind of 19, 20 level. So implied vol is give or take in the same spot. I think we were more elevated into the start of October in terms of implied vol versus previous elections, and that seems to have subsided. I think there's a geopolitical element to it, and as I mentioned with Jack before, I mean, the idea that the election may not take place was also kind of a wonky one, right? Given that there was 2 assassination attempts, and so again, not a partisan comment. Do you need to hedge out the effect that maybe we don't have an election, or the election has suddenly a wrench is thrown into it, and God forbid if something happens, right? So I don't know if some of that is easing now that there's more security. I really don't know. Like, it's just conjecture, and a lot of this is just for fun. There's probably a lot of factors in it, but the vol complex seems to be cooling off, and then again twisting in favor of calls versus puts. So yeah, drug is this other stock. I don't know that actually has options on it. Does it? This thing was going crazy, and some of these things just have. Yeah, it may not actually come up in an equity hub. It may not have options. It was a stock that didn't mean anything to anybody 2 weeks ago, or 2 days ago even, and now means the world. Yeah. Okay. And then last thing is Bitcoin. So one thing I want to note on Tesla here, to the point of what's happening in 0DT options, like the only flow right now is 0DT. You can see that, right? Purple is 0DT the purple line is all expiration flow. Teal is 0DTE. So today's just 0DT flow. There's really nothing going on. There's nothing material happening in this market. It's really pretty quiet. And so, does that mean that the condor trade gets more attention? Every time we tick higher, feels like it, right? Don't know. But that's the big trade that's on the board there, right? That's the biggest trade going on at the moment. And then we should start to chip away at this positive game into the end of the week. And then lastly, we'll take a look at Bitcoin and some of these names. The problem that I have trading like an MSTR or something like that is that I don't know what Bitcoin is going to do. And it's sort of like if you buy a gold miner that's overbought, but gold keeps going up. Well, what do you do about that, right? Because you look at this as like a commodity name. The call skew here is very high. Bitcoin obviously is having a tremendous move. I think I have to do BTC here. Actually, I never try to. Yeah, so we just look at Grayscale as a proxy here real quick. Bitcoin's had an incredible move up. I think we're testing 67, 68,000 in that neighborhood, and so the implied vol here. I mean, this is a when Nvidia hits like its peak, call skew or peak implied vol, like this is the type of bullish skew that you see in Nvidia, right? Nvidia is down like this, so this is very elevated, but Bitcoin's having a big run. But so how do you play this? Like, you can put on some interesting structures, but ultimately you're really just making, in a lot of ways, a bet on implied on Bitcoin itself, right? And from what I understand, the stock MSTR relative to Bitcoin holdings is overvalued. So, like, why wouldn't you make a pure play bet? I don't really know. I don't want to dive into that aspect, but this is overbought. That's how I read this. Now, if Bitcoin doesn't come off anytime soon, then can that vol hold up? It can. So it also, it's not always that easy to sell just, hey, let's just sell call spreads in this, because this skew is elevated. So you're not necessarily getting a really, great setup, I would argue, for selling something like a standard call spread. And you definitely don't want to go naked short calls in this kind of a situation. So, it's a challenging name. What kind of upside do we see? So what I like to look at is just a base level is, are there call strikes above, where are the big call strikes? Those can oftentimes be very interesting upside targets. And so when you look at MSTR trading around 200, 225 starts to make sense. And then you see the positions really start to tail off under that, maybe all the way up to 250. If we were at 250 right now, I'd be like, okay, there's no more calls above there. Like, this thing is really due for a pullback, even a relative pullback. But this thing seemed poised for strength. I do think Bitcoin it's up a lot over the last couple of days, so it just seems really rather extended. Typer Lover asked an interesting question. He says, is there any evidence that SPX 0DT options are in any way linked to Nvidia options? Yeah, if you start to think about correlation and dispersion trading, we've linked on this idea before, and my friend Sam at Oppenheimer, I don't know if he's here, but he has a lot of great work on this, where he looks at the prices of 0DT straddles relative to S&P straddles, and the idea is that you could offset or trade the two against each other, and I think that's totally true and very possible. And I think, in fact, that's what a lot of this volume is. I mean, this bid just coming into Nvidia is really wild right now. So, can you on a average basis sell Nvidia or buy Nvidia straddles against 0DT SPX straddles or something like that? Maybe, sure. And in fact, if you look at a lot of Nvidia volume, it's pretty two-sided oftentimes. And the fact that that skew is not that high, even though the Nvidia options volume is high, tells us that, it's very concentrated, short-dated volume, and seems pretty balanced. If it wasn't balanced, then I don't think we'd have vol that would be kind of so low. But this feels to me like it's starting to warm up and it changed a little bit. So I think you could trade Apple, Tesla, Nvidia, those big, mega cap stock options versus S&P 0DTEs, and I'm sure there's some kind of, let's just call them relative value type strategies there that some smart people worked out. So nice question. I think that's definitely true, and something to really look at. Last question is, how do we know today's call spread is a credit spread and not a debit spread? So there's data that we source that helps us to understand this, and then what we do is we run that data through our proprietary models. And that is how we know that, or at least have strong conviction as to where options are bought and sold. So that is how we have a view on that. You can't just take this raw data and kind of jam it in. You gotta massage it and model a little bit, and that's what we've been doing since January of this year, getting ready for the trace launch that happened last week. All right, we're rounding up to the top of the hour. Again, if you're interested in downloading the Opex spreadsheet, which shows you which names have the biggest options expiration, go to spotgamma.com/Opex, and you can catch a list of those big Opex names. If you're interested in trying out Trace, if you go to spotgamma.com and try out our Alpha subscription, there are both monthly and annual plans available to kick the tires on that. I think it's a great time to watch all this stuff, given the huge iron condor. It's been persistent in the market, given the options expiration in 2 days, and then obviously given the upcoming election, the options market could be particularly insightful, I think, over that period. All right. We hope that was interesting for everybody today. I didn't get a chance to play my applause stuff, but I got a new soundboard. Applause for talking to myself for an hour. If you have any questions, you can email us info@spotgamma.com. I'm at SpotGamma on X or Twitter, and you can also go to youtube.com/SpotGamma as well. So we hope to see you around the Discord channel or other parts of SpotGamma in the near future, and we'll be seeing you very soon. For subscribers, we have a 1 p.m. webinar, so I will see you even sooner than that. All right, good luck to everybody. We will talk to y'all soon.